What if your set it and forget it portfolio in the S&P 500, something that we've held and trusted for many years, is now quietly becoming a trap? Many experts are saying that the approach of just buying the S&P 500 might not be enough. Now, before you go panic selling, before you pull all your money out of the market, there is a smarter way to evolve this portfolio that we're going to be talking about today. So stay with me throughout the video. I'm going to show you when the set it and forget it portfolio with the S&P 500 still does work, when it doesn't, and how to tilt that portfolio for really a better risk adjustment and of course some accelerated growth. Now let's start with the set it and forget it portfolio. This is in the context of the S&P 500. Now, if you're unfamiliar, the S&P 500 is the 500 largest companies within the United States, meaning that you have diversification, you're invested in a lot of different sectors. But with it being market weighted, there are some companies like Nvidia, when you look at Alphabet, when you look at Meta, that are very, very heavily weighted and they take up a bulk of the S&P 500. Now, over the past decades, buying and holding the S&P 500 has been a passive strategy. We have low income, broad diversification across a large amount of companies, US equities. We let compounding do the work, and that is the reason why I do hold the S&P 500 in my portfolio. Now, many investors have said it's going to be the core of any long-term portfolio. You set your allocation, you rebalance on an annual or semi-annual balance in the portfolio, and don't overreact when you hear noise in the market. If you're seeing it on social media, not really reacting, because we know over an extended amount of time, the S&P 500 grows roughly around 10%. Now, it works, and it has worked very well when we see upward trending markets. When we look at the 1980s, the 1990s, even the early 2000s, and over most of the last decade, the S&P 500 does incredibly well. But a lot of people that are entering the just hold and relax approach really deserves a fresh look at the portfolio to change it a little bit. So what is really changing with this? So why are some experts saying that it is time to reconsider the set it and forget it? And how are you gonna, and what arguments are there, as well as the risk within these portfolios? Now, the first one and the big one, valuations and market leadership concentration. So when we look at the S&P 500, it is near record highs. Even this year, I know there have been days and weeks and months that we have been seeing record highs, more record highs, even higher record highs, because most of the gains have been driven by a very few handful of mega companies. When we think of big tech, artificial intelligence, this means the risk within the S&P 500 has become very concentrated within there. And when you start thinking about diversification across all 500 stocks, even when you start getting to the bottom of those stocks, you are owning them in a very, very small percentage. And of course, it really diminishes the margin of safety that we have within the S&P. After years of gains, the buffer for future earnings is getting a little bit thinner, and people are predicting a 5 to 10% correction, or possibly even worse, meaning it could affect your IRR, or your internal rate of return. When returns are lower, fees, taxes, and really dragging from underperforming can eat into the results. Now, in addition, there is changing macro and regimes risk, monetary policy shift, the government being shut down, inflation surprises, tariffs out there, global instability. A lot of things can really affect the US markets, and really heavy weighted large cap momentum funds that we're seeing in there don't win in every single thing. Now, of course, when it comes to the S&P 500, you also do have to look at your opportunity cost, as well as the exposure to growth areas outside of these large caps. Strictly staying in the S&P 500 fund, meaning that you're neglecting your mid caps, your small caps, international equities, emerging markets, alternative strategies. So many different things are really excluded in their entirety if you're only investing into one single ETF, such as the VOO. And you could also be looking at downturns in the near future, meaning a lot of people make, and I don't understand, try to wrap my head around the emotional decisions. They sell low, they lock in losses, and they buy when the market is on fire. We see all-time highs. People are putting money in the market like crazy. As soon as we see a dip, everyone just goes ahead and gets rid of it and sells everything, locking in those losses. Really blind to the set it and forget it mentality that we've ever seen before. So where does it make sense? If you're looking at something, and honestly, for truly a long horizon, we are looking at 20 years plus. Over long periods, your market circles really do average out. Staying invested for the long term really will be rewarded with the patience you have, and also making those constant contributions. Now, for me, this is the big one. for the core allocation. When I think of the S&P 500, it is the core, it is the foundation, it is the base floor in a portfolio, but it doesn't make up your entire portfolio. This is the reason why I introduce things like the QQQ, VOO with the S&P 500, but also looking at something like the SCHD or looking at crypto and putting a couple percentage in a couple different places, which can make a really big difference. Now, of course, if you lack time, if you lack resources, or if you're actively overweight or trying to rotate these portfolios, the time, the taxes, mistakes, honestly, if you don't have time for it, guys, this is still a very big set it and forget it portfolio, just investing in this S&P 500. And if the index is done in tax advantage accounts, the drag is much lower in here. So of course, you not only just the set it and forget it, which part of the portfolio should be active, what should be passive, where should it be invested elsewhere. Now, of course, when we start looking at the evolution of the S&P 500 itself, this is where a couple strategies come in without over complicating things, such as strategic tilts. Now, we've talked about this a little bit. When you start looking at an index, you can tilt different sectors towards, let's say, technology, AI, climate, healthcare. You could go value versus growth. You could go small versus large cap. You could go momentum versus mean. Depending on exactly what you're looking for, there are some different ways. And again, thinking about, and we've talked about kind of the satellite or the complementary approach, meaning that if you're going in for something like the S&P 500, and let's say, for instance, it's 60% of your portfolio, you could add 10 or 15, maybe even 20% into small cap, some into mid cap, some into international. This is going to give you diversification outside of that S&P 500. And I know my personal financial advisor always yells at me because I don't carry international. You could also look at alternative assets. Now, these are going to be introduced, and I believe it's going to be going into next year, into those 401k plans. So looking at real assets, looking at REITs, commodity, private equity, cryptocurrency, a lot of things are going to be added into these portfolios in the future. And of course, you can look at a dynamic rebalancing schedule within here itself. Rather than rebalancing annually, you could do it every 3 months, every 6 months, use drawdown controls. You could do stop losses. There's a lot of different things you could do to really rotating out of lagging sectors and rebalancing into other sectors within the portfolio. And of course, you could be mindful and definitely be mindful of the turnover when you look at taxes, when you look at trading costs, if you look at slippage, when you look at tax harvesting. There are so many things that you could do in here, keeping an active side of it, and then kind of like the passive side of it with the satellite portfolios really does make a big difference. So how exactly could we kind of approach this strategy? When you look at the core plus the satellite approach, that's kind of what we're looking at. When you start thinking of the S&P 500 index itself, that could be 60, 70% of your allocation. So again, that's going to be the core. That is going to be the foundation. Then you can circle it or really satellite approach with smaller, more flexible ETFs for a higher upside or even more defensive, where when we start thinking of something that has a higher upside, looking at like a QQQM or something that is going to be very growth orientated. If you want to go a little bit more defensive, thinking of something like the SCHD, again, makes a big difference in there. Now you could also go with limited active instead of going in and having the S&P 500 at that, 50, 60, 70%. You could put 5%, 10% into mid cap, 5 or 10% into small caps, and of course, keeping it from just being in that one single place, or even going into something and having VOO kind of as a core, and possibly getting some overlap with something like a VTI, or just doing the VTI in the entirety. That way you do have exposure to those mid caps and those small caps within there itself. Now, of course, with any portfolio, guys, periodic reviews, not the daily obsession. I know a lot of people that invest and they look at the portfolio one time a day, multiple times a day, maybe 7, 10 times a day. If you're looking at that under a microscope, you really need to look out at what is it doing in a year? What is it doing in 3 years, 5 years, 10 years, maybe even 20 years? Don't get sucked into the daily noise. Don't get sucked into social media. That is talking about, oh, the government shutting down. Guess what's going to happen? The S&P 500 is going to tank. We have seen since the shutdown, we have seen actually positive days of the S&P 500, even though the government shut down. So you have to know exactly what you're doing. Now, of course, when it comes to any investing portfolio, you also have to evaluate the risk. Forecasts are uncertain. You never know exactly which way it's going to go. If you're at a younger age, playing a lot more of the growth aspect, If you're an older age getting ready to retirement, looking at something a little bit more defensive like the SCHD could really make a big difference. So is the set it and forget it S&P 500 entirely dead? Is the strategy dead? Not entirely, but in today's market, you have so many different options out there. Staying strictly invested into one single thing without any flexibility does increase your risk to the market itself. Smart move is evolution, not abandonment with that S&P 500, using the index again as your foundation, flexing around it with those satellite ETFs that we see, looking at tilts, looking at satellites, controlling the risk, and periodically looking at to review here. So if you're rebuilding or you're refining the portfolio, which is exactly what you should do, what's your base exposure? Think about it for a minute. If you got something like a VOO or a VTI, now of course when we talk about the S&P 500, it could be any of the funds. There's the SPY, there's the VOO, there's the IVV. There are so many different iterations that track the exact same index with the S&P 500. So how much room do you have for tactical play? Knowing myself, having 20 plus years to retirement, having that core as the VOO, and then looking at some of those very high growths when we start looking at like the Van Eck Semiconductor Fund, when we start looking at NVIDIA, when you start looking at the QQQM, really does make a big difference. And of course, not trying to just match the market like we have with the S&P 500, but even earning a couple percentage with something that is a little bit higher growth makes a big difference. Now, of course, if you enjoyed this video, guys, hit the like button, subscribe to the channel, drop a comment down below. What kind of satellite exposure are you using? Are you using the S&P 500 as that core? Are you using the VTI? I'll read and respond to them as soon as I can, and I'll catch you in the next video.